Okay, what I thought I'd do this Saturday morning, apart from sit at the screens all day, working on my edge, is just cover a stock I bought near the highs. Somero, S-O-M. So I've traded this one a few times in the past. It's been good to me in the past. First things first, let's just have a look at this stock. I rank everything by growth, and this one wasn't bad actually. It made a move out of this stage one base here. In fact, I'll just reverse this up a bit more because I'll just go back to when this broke trend, and we broke trend well and truly here, this red line here, and down it came. I put my targets in as I always do, and when I put these targets in, I'm not saying I'm short the stock. I'm not saying it has to go there. I'm just saying when past leaders or stocks that have made a good move break trend, meaningfully break trend, as some did, they tend to, give back half of the prior run to, up to sort of, even the best tend to give up half the run is basically what I'm trying to say. So, when someone says good company at a good price, well, are you prepared to give back half give back half of the value of your investment, because a lot of them go there. So that's something you can just back test yourself on stocks what a broke trend. And last chance saloon, as we call it, is the 52-week low, what you can see here. So, once it's traded these areas, and I mean, this is the classic, comes right close to this T2, bounces all the way back up into the supply, and down it comes and trades it. This is where I say, I don't have a bias on this one anymore. Reward to risk for anyone who was short is kind of getting thin, if it's, one of the better stocks. And this one's, sorted itself out again, didn't it, after the pandemic. It's what I call a reverse vol base. And it broke out and it went on a straight line run. Now, why didn't I take this trade here? There were so many good trades what we took in a little bit earlier. This one was like a little bit messy with a bit of supply, and there were better trades to take, CER, WATR, SDI, and there were just better trades out there. So this one was lower down on the pile. Now, why did I take it here? Well, we were killing it in the market. I had so much sort of, I rolled out of a few sort of ones what were just going up on the back of the pandemic, and I think VLG might have been one of them, and I rolled in out of a couple of the gambling stocks or whatever I was in at the time. I can never remember what I'm riding, can I? But and so I took this one here. I'll show you where I bought it. I think I bought it here, and it did this, then it did this, then it did this, and I'm not sure whether I got stopped out here or I said this one has violated my stop area and I sold it sort of here, and then I think it gapped up pretty soon after I'd sold it and it went right back to highs, and it made this a real obvious broken trend area as well. And I've got some targets. It's hit that target one already, and down it goes. But basically what I want to show you, because coming out of this bad market environment, there's going to be good stocks and they're going to set up, and it's probably going to be different ones than what were the favourite ones. It usually is. Some of the old favourites from the last run do recover, but let's just zoom out and I'll go back to, in fact, let me go on to a clearer chart. I'm sure I cheated that base. Let me just, I've got a better chart to do this with, not that one. this one. This has just got 52-week highs, 52-week lows. And let me just, I'll just, this is another big picture charting as well. I'll just talk about the 200-day or the 10-month moving average. So the old classic, and there's my original entry as well. I actually bought that on this day here, didn't I? I still got my original. Been using ShareScope Pro for over 10 years now. Before that, I used to use the LSE, but it never saved the drawings. Talking about the 200-day moving average, I'm talking about 52-week lows, 52-week highs. Always put your log scale on. Comparing past price action, it's just a lot better. So, it broke out. This is 52-week lows, 52-week highs. It didn't visit 52-week lows. It visited it here. It had already broken trend actually, and then off it, it died a death, didn't it, from there onwards. Now, there you go. Simple rules. Good stocks don't trade 52-week lows when they're doing good stuff, and it always ends. The run always ends. It always does. The next thing is, below the 200-day moving average. I know I've done this many times before. If it's below the 200-day moving average, it's, that's where you should exit. I'll just call a big, nonsense on that. So 200-day moving average, 200-day moving average, 200-day moving average, 200-day moving average, 200-day, over and over, 200-day. So what do you learn here? Well, you find reward to risk on these corrections. So you longer term investors who like to get in on, this might, there's a chance these high growth stocks do dip into sort of a growth, respectable growth valuation. Good growth rarely trades at value under normal market circumstances. It's so rare. You might see it in terrible market environments, but in good market environments, good growth rarely trades at value. So you have to be a bit looser on those parameters, don't you? Don't take my word for it. You should just go into the old back test and do it. But what is important about the 200-day here? Well, what does it tell us? It's rising over 200 days. If it's rising, the trend is up over 200 days. If it's falling, the trend is down. So just respect that, because selling something below a 200-day, it might be where a pullback trader is getting fantastic reward to risk, because the 200-day is still rising. Now, where things get a little bit tricky is where you're buying below a falling 200-day. So see how it's falling here and you start buying here. That simple rule will keep you out of trouble. So simple rules for longer term players like myself in small cap trends as well. If the 200 days falling and it's still above the 52-week lows, there's a chance you need to exit that stock if it doesn't play. I don't want to get involved really. I want to get involved in better action than that. So just think about that. It's actually started falling over the past 200 days. It's still above the 52-week lows, but you can lose a lot of money. You can still use half your money from 52-week lows. I'll tell you now, you can lose 100% of your money from any price, as we know. So that's another health check to do. None of my stocks in my portfolio will ever be in a downtrend for my time frame. Sometimes a stock will trade sideways for a long time, and they will dip into emerging bear territory, or my stop will always take me out of that stock, on the breaking trend pretty soon around that area. So, stocks can go to sleep and go sideways for a long time, and it is what it is. But when looking for good stocks, you're going to be looking at stocks what are probably, they've got some bad action behind them, and they're going to be rising even though they haven't broken out yet. So just think about that. I think around this time, I can't remember, was it Michaelmarsh? There was a lot of stocks. There you go. There's my old buys. I'm looking at historic buys. These blue ones are historic buys for me back in the day. Wonder if my Trifast ones are still there. Yeah, I bought Trifast sort of in here and through here as well. Haven't got that one. AMS was bought again in this area as well. I got in AMS again. Can't remember where. Anyway, besides the point, isn't it? Just keep your charts real simple when you're looking at these big picture things. This is so simple but effective, what I'm trying to show, and I'll tell you, the investor who gets caught up on daily time frames and level 2 and this and that can't see the wood for the trees. Stocks what are sort of going sideways, pressing against 52-week highs, they are the strongest stocks, and they're going to look like this on your chart up in the top right, and you're not going to look like you're getting a bargain. Guess what? It's not about, it's about making money, this game. It's not about being right on valuation. It's about how much money you make when you're right. So some simple rules. These are just big picture things what are really easy. But another thing to do is always go through your time frames and look at volume. So it's always worth just, you're not always going to see the volume on a monthly. This one breaks out on monthly volume, but you want to know before it breaks out. And I like to see levels built on volume, and this one's not really showing much here, is it? It was quite... Some stocks are very, very sleepy as they're building these levels, and volume comes in on the break. But other stocks will actually build the levels on volume. You'll see you've got a level on volume here, and you've got a bit of volume traded here. See this volume here with this narrow range bar? A lot of shares changing hands in this on this bar here, and it's not moving price. It's soaking up the volume, and this, big volume update here. No sinister distribution what you see at the other end. You start at the other end, you start to get ragged price action. And go and look at Gore, and then you start to see distribution. So see this distribution here and distribution here and distribution here. So go through those big picture charts, at least a weekly chart. Don't get too lost in the close action. Zoom your charts out. Just put some real simple sort of levels in there, and get a feel for what's holding up in the current market, and that's going to be a pretty good the best lessons I can give you for longer term holds. It doesn't matter whether it's stocks, investment trusts, it doesn't matter what you're trading, but this will all stand true. When the time frame is falling, I'll tell you now, good trends tend to average. Outliers tend to average maybe 18 months, 2 years hold time. Some longer, some shorter. Some go up fast, some trundle along and make good moves. But just be aware of, this is a void action, isn't it? It's falling over that time period, and there's absolutely no need to front run these falling trends, because at the end of the day, you don't know where it's going to end. You still get good prices when they start rising again. So It's about what you capture. It's not about what price you get. So there you go. You know, I was on some, wasn't I? I can't stress enough that this game is not about being right. It's just about how much you make when you are right, because you're going to be wrong a lot. You know, everyone's wrong around half the time. Be it Warren Buffett, Paul Tudor Jones. It doesn't matter whose name it is. Everyone's wrong about half the time, and it's about how much you make when you are right. So another thing worth just talking about here is, you know, when you are right and you start lightening up on these positions, that just means that it skews the how often you are going to be right ratio. It skews it against you. It means to make money you've got to be right more often, and you never want that. You want to be right. You want to make money if you're right 30% of the time. You really do, even less than that. And so I know people say there's more at risk when a stock's rising and you've got a bigger position. You know, depending on how concentrated or how diversified you are, you know, that is the problem you want to have. And at some point, you know, small swings in the stock price will have big account swing effects. If you get to the stage where it really is a problem, well, you're doing things right. And micromanagement, vol targeting at that end of the trade isn't a bad thing, is it? But you don't want to be doing it before you've got the big weighting problem, because everyone does that. Everyone lightens up, or, you know, a profit is a profit. And I'll tell you now that a profit is the quickest way to the poorhouse, because the losses are still going to be there. You're still going to be right around half of the time. So, you know, these are small to mid cap stocks what tend to trend and make these trending runs, and tend to make the more volatile moves, you know, where a lot of investors capture their edge in the UK markets. You know, these are not efficient main market stocks what bumble around and pay you a dividend over time. So, you know, you've got to think about these things when it comes into managing. A lot of people will snatch at profits early in the next market run. I'd rather give those profits back and be wrong than snatch at profits and, you know, turn the sort of reward to risk ratio upside down on myself, which is basically, you know, you want to get a big reward for a little risk. Okay,